Welcome to the latest Motley Fool scoreboard. I'm on in Chock-a-Bloom. We've got longtime fools Jason Hall and Matt Frankel giving a 1 to 10 rating to Laboratory Landlord, Alexandria Real Estate Equities, ticker symbol ARE. Rate the strength of Alexandria's business first, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Jason's at a 7. Matt, you're just at a 5.
Yeah, and this is a business I really like in a lot of ways, but really just in simple terms, life science properties were heavily overbuilt during the pandemic era. Like companies like Pfizer were saying, we need more space, we need more space. So it's not really Alexandria's fault necessarily, but we're seeing this overbuilding really play out in the numbers. Their occupancy has fallen from 94.8% to 90.8%, so 4 percentage points over the past year. That's a big drop for a real estate company in 1 year. And rent increases on new and renewals. So pricing power is down by 2 percentage points year over year. Of the properties that they have under construction scheduled for delivery in the 2027-2028 timeframe, because these take a long time to build, only 28% of them are pre-leased or in negotiation. So more red flags than none.
Yeah, no, I think that's directionally Matt and I are actually probably a lot closer than our scores might represent. I think I'm just a little more optimistic that the demand picture can improve probably more quickly, but there are definitely real risks, and it's an ugly, ugly time in the cycle. But I think once you get through kind of the weak part of the cycle right now, it's a wonderful industry, and I think the tailwinds are still incredibly strong. So maybe I'm waiting more in thinking about the long tail here of the business itself and a little bit less about where Alexandria is right now. I will also note that Alexandria Real Estate, a company that's largely in life sciences with lots of properties in places like San Diego and Boston, Alexandria, of course, its headquarters in Pasadena, California. That makes perfect sense, right?
Right. It's a reference to the Egypt Alexandria, right?
Of course.
The knowledge.
Of course. Yes.
Well, Motley Fool's headquartered in Alexandria, Virginia. We can be a little navel gazy and hope that it was here. For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Both of you are at 6s, Matt.
Yeah, I said a 6. It's a meh. Peter Moglia, he's CEO. He has been the sole CEO since mid-2022, so for about 3 years. He was previously co-CEO. His fellow co-CEO retired. The founder, Joel Marcus, is still involved as executive chairman. They were a bit too aggressive on the growth strategy a few years ago, and they're paying the price for it now. But like I said, not totally their fault. If the big life science companies are saying we need more space, that's not necessarily the bad call to say yes. But the market's having a tough time absorbing what they're building now.
Yeah, a year from now, we could be saying that he's a 4, or we could be saying he's an 8. And it just depends on what happens with that roughly 3/4 of properties that are under development that they don't have a tenant lined up for, right? So was management visionary in getting ahead of things and taking on some risk, or were they way ahead of demand and over leveraged the business? So right now I come down on a 6.
For financials, a 10 is a fortress, a 1 is yikes. Both of you have 6s again. That's what you averaged on the first 2 categories. Go ahead, Matt.
See, there are a lot of yikes measures here. Like the same property net operating income fell by more than 4.34% year over year in the second quarter. Their debt metrics are up, which it's just with vacancies, that's what's going to happen. You're not earning as much money. But on the other hand, the company does have $4.6 billion in liquidity. Less than 10% of its debt matures over the next 2.5 years, which is very low in the real estate industry. So it's a real mixed bag, and that's where I arrived at a 6.
Yeah, I think they're going to need every day of that 2.5 years before they start to see debt maturities accelerate to get business in order. And hopefully the life sciences environment does improve before then. I think it will. I think the biggest likely outcome is we go through a period where the dividend stops growing. There's also a world where the dividend does end up getting cut, but I think that's probably the worst case scenario is just we see a little bit of a dividend cut versus something really bad happening.
Right, Jason. Let's talk valuation. Let's get all your worlds together and see what you think Alexandria's stock's going to do in the next 5 years. How safe is it? 10 is a sure thing. 1's a lottery ticket.
in a world. So it's tough. This one's a little bit tough to read. So I think looking at the the kind of higher risk, maybe the probability of just the market doesn't recover quickly. My safety score was a 6, and it reflects that kind of more binary risk. I think the likely outcome is probably the higher end of that 5 to 10% annualized return. The market's already thinking that to some degree that there's that binary risk, maybe the dividend cut. So you see that 6.3% yield and you think maybe that's the floor. Maybe not the floor if they do have to lower the payout. But I think there's also a very real chance that the world that we end up living in is returns are more like 15% a year. The conditions improve. All of a sudden they have faster uptake. They don't have to start taking lower and lower rents just to cover interest expense and operating costs for the buildings. But we're gonna find out the hard way, and that's by kind of living through the market.
You know, like on one hand, there's a real risk this could be like the next medical properties trust, right?
Yeah,
if things
right.
don't go the right way, where they have to start selling off assets to pay off debt and things like
Mhm.
that, and to get their balance sheet right. But there's also the upside risk that their properties will be absorbed. That they will retain the high pricing power they've always had, and that those markets will recover. And I mean, I can definitely make the case for 15% in that case. I'd said 5 to 10% really just sits in the middle of the likely outcomes that I
Yeah.
see. And I mean, they do have the asset quality is a big safety helper. That 6.4% dividend yield, I don't think it's going to be a cut. I think it's going to stay where it is, but I do think it'll help drive total returns over the years.
Yeah, maybe a little bit, Matt, kind of like we saw with Digital Realty Trust a few years ago, where there was this massive overbuild, and there was this period where a lot of us were really concerned it was going to have to cut its payout, and its balance sheet's okay now. But one of the things it started to do is kind of lean into maybe things like joint ventures. It has a joint venture with Realty Income, and that's possibly a path that we might see Alexandria go down too, where they find other partners to help them get through this period without absorbing the big hit on their balance sheet and just kind of holding firm with their payout.
Time for everyone's favorite topic. Jason, is there a company in Alexandria real estate equity space that you like better?
So I'm going to stay in REITs, but I'm going to look beyond anything related to healthcare or life sciences. And I'm going to focus on people that are looking at as, hey, this is a stock that's down, the yield's up. I think it's going to get through and everything's going to be fine. You're thinking risk reward. I would look at Rexford, ticker REXR, which is an industrial REIT that lives just in Southern California. That's where they're focused. Global trade and tariffs have sent the stock down. But unlike we're seeing with Alexandria, where its business is struggling right now, Rexford's business is holding up really, really well. And I don't think it's going to get upended by tariffs and major shifts in trade away from Southern California. I think the business is going to hold up really well, and it's really, really compelling where it's priced right now.
Yeah, I'll stick with the healthcare real estate space. I like Healthpeak Properties, ticker symbols DOC. They do have these kind of lifestyle or life science campuses, but they also have substantial holdings in medical offices and senior housing communities. They really help to offset that. It's more of a well-rounded approach, and they have a high dividend yield if that helps.
Thank you to both Matt and to Jason. They've given Alexandria Real Estate Equities a low overall score of 5.8 out of 10, with all the categories kind of hovering in that area. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is something good, I promise. Till then, Fool on.
And we get like 2 or 3 comments every full live show, like, where are the dogs?
That's funny.
One of them's actually asleep under my chair right now. Yeah, they decided not to have a fight to the death during this recording yet.